Welcome to this explainer. Today, we're cutting through the market noise to look closely at the structural economics of three financial data giants, S&P Global, Moody's, and MSCI. We aren't here to talk about short-term stock momentum, the latest hype cycle, or dramatic market narratives. Instead, we're going to put on our hats as disciplined capital allocators. We are going to look strictly at business economics, cash flow, and structural durability to understand exactly how these three businesses operate at their absolute core. So, what are we actually trying to figure out here? It really boils down to this one central question. Which of these three businesses offers the strongest risk-adjusted compounding? In the world of long-term investing, the central economic tension is always finding a business that can consistently earn returns well above its cost of capital. And critically, one that can sustainably compound those gains over the long haul without totally falling apart when the macroeconomic weather changes. To do that, here is our valuation framework. We'll start with the capital allocation question, explore their three unique economic engines, weigh the margins, moats, and trade-offs, stress test them for fragility, and finally deliver the compounding verdict. Let's dive right in.
Section 1. The capital allocation question, establishing the baseline for long-term compounders.
Before we evaluate the companies themselves, we have to establish a standard. What actually makes a long-term compounder? Exceptional economics are not defined by temporary accounting peaks or cyclical spikes. No, we demand high, durable returns on invested capital. We want a toll-booth-like business model that demands payment regardless of what the broader economy is doing. Add to that an ample reinvestment runway, disciplined management, and wide structural moats. That is the baseline we are measuring against today. Section 2. Three unique economic engines. Let's seamlessly map out how these businesses actually generate their cash. Starting with S&P Global. Think of them as operating a massive, diversified double toll booth approach. They have two incredibly embedded core franchises in ratings and indices. These operate at exceptionally high margins. We're talking mid-60s and up, providing a massive, steady cash foundation. Now, they do have a market intelligence segment that operates at a lower margin, right around 20%, but this breadth is highly intentional. It might dampen their peak growth slightly, but it radically improves their overall stability. Now, contrast that with Moody's. They operate a much narrower but undeniably lucrative credit ratings oligopoly. While a majority of their revenue is indeed recurring, a massive portion, nearly 40%, remains deal-related. This means the Moody's cash engine is heavily reliant on cyclical debt issuance. Basically, when companies issue bonds, Moody's prints money. But, as we'll explore in a bit, that cyclicality introduces a very distinct structural risk. And then we have MSCI. Their economic engine is remarkably efficient and laser-focused. They derive about 57% of their revenue strictly from indices, but get this, that single segment drives over 70% of their operating profit. It's a model relying on incredibly sticky asset-linked recurring fees. With client retention rates historically sitting over 95%, MSCI essentially functions like a steady annuity that just automatically scales up as global equity assets under management grow. Section 3. Margins, moats, and trade-offs. Let's look at structural advantages and capital discipline. When we compare the overall profitability of these three, a clear separation emerges. Moody's sheer profitability is the direct mathematical reward for holding a near monopoly-like dominance in the credit rating space. It is incredibly high. S&P's core segments actually rival this, even though their consolidated number is slightly diluted by that intelligence unit we mentioned. MSCI sits comfortably but noticeably below those peaks in the mid-40s. But listen, margins only tell half the story here. We have to consider the strategic trade-offs required to achieve them. And here is the core trade-off a disciplined allocator must weigh. With MSCI, you are buying into faster growth, driven by the massive secular tailwinds of passive investing and ESG mandates. However, you're accepting higher execution risk and a premium valuation. On the flip side, with S&P Global, you accept slightly slower, more mature organic growth. But in exchange, you get deeply embedded economics and massive, highly predictable cash generation across multiple economic cycles. So what exactly does S&P do with all that highly predictable cash? Between 2023 and 2025, they returned over $15 billion to shareholders via buybacks and dividends. That is a staggering number, and it's a true testament to their capital allocation discipline. Management didn't just hoard cash or go on a reckless empire-building spree. They actively pruned non-core assets to fund these massive capital returns, structurally compounding shareholder value.
Section 4. Stress testing for fragility. Let's find out what breaks when the markets turn hostile.
A rational allocator doesn't just look at the bull case, right? We have to integrate risk naturally. Let's start with Moody's. Because of that heavy reliance on deal-related revenue we saw earlier, their degradation cascade during a downturn is sharp. If global credit markets freeze, corporate debt issuance plunges. When that happens, Moody's pricing power basically evaporates, and their margins rapidly compress. Because their fixed costs for maintaining that rating infrastructure are so high, their bottom line takes an immediate, painful hit during a credit crunch. Now, MSCI's fragility looks quite different. Their cash flow doesn't just freeze overnight like Moody's might, but it is highly sensitive to total market values. Think about it. A prolonged multi-year bear market, or even a sudden cultural shift back toward active management, would directly suppress their asset-tied index fees. While they'd certainly remain cash flow positive, their margin expansion and that high-growth narrative would hit a serious brick wall. S&P Global, however, degrades the most gracefully under pressure. Why is that? It comes down to structural buffers. Even if new debt issuance totally dries up, S&P still collects billions through annual contractual surveillance fees on existing debt. Combine that with their diverse benchmark licensing for passive funds and a highly adaptable cost structure, and you have a business uniquely positioned to soften the blow of cyclical volatility much better than its peers. Section 5. The final compounding verdict. Time to synthesize where the margin of safety actually lies. Synthesizing all of these structural characteristics, a very clear hierarchy shakes out. S&P consistently leads the pack in business model stability, carrying the lowest overall risk profile. Now, Moody's possesses arguably the single strongest moat with its pure ratings oligopoly, but its cyclical risk heavily drags down its long-term compounding predictability. MSCI sits right in the middle. It offers stronger growth than S&P, but it stands on a somewhat narrower economic base. Remember our baseline standard from the beginning? True compounding requires a sustainable reinvestment runway. S&P secures this simply by generating over $5 billion in free cash flow every single year. Because they aren't purely reliant on cyclical debt peaks to make money, they can deploy that capital steadily. Through disciplined tuck-in acquisitions and share repurchases, they just grind out durable gains year after year after year. So, the verdict? Based purely on the structural economics from our deep dive, S&P Global stands out as the strongest vehicle for risk-adjusted compounding. Yes, it sacrifices a tiny amount of the peak growth potential you might find in an MSCI, but in return, it offers an optimal, diversified blend of stable margins, deeply embedded network effects, and robust, proven capital return strategies. It is the most resilient compounding machine of the three. But as rational allocators, we must always identify the variable that could prove us wrong, right? S&P is the safest compounder today. However, if the relative flow of market assets into passive versus active funds accelerates far beyond current expectations, MSCI's highly efficient asset-linked engine could absolutely surge past S&P. That relentless flow of global capital is the single macroeconomic variable you need to watch. Thank you so much for joining me on this explainer, and as always, keep your focus on the underlying economics.